February proved to be an altogether more challenging month than the past few, which since September last year have seen most asset classes recovering strongly. And like much of last year, it was the outlook for interest rates that drove weakness in bonds, which rippled across the equity markets and beyond. At the start of the month, the US Federal Reserve increased interest rates by 25 basis points to a top end of the range of 4.75%, as was entirely expected by markets. But their dovish accompanying statement was later undone by a stream of data that pointed to relatively buoyant economic conditions and stickier than expected inflation. Focusing on the all-important US economy, consumer price inflation there came in higher than expected at 6.4% in January, while price measures which change only slowly and can be more difficult to rein in also remained at similar levels and at the high for this cycle. The labour market continued to show resilience with a surprise increase in payrolls in January, and unemployment fell to 3.4%, heightening fears that the Fed has not yet tightened enough to cool the labour market, while a range of leading indicators in the US and beyond pointed to stronger growth and continuing price pressures. Indeed, global growth forecasts have been revised upwards, helped by China's post-COVID reopening growth surge and the dramatic fall in gas prices in Europe, which to date has avoided a widely expected recession. With ample evidence suggesting that the inflation genie is by no means back in the bottle, developed world central banks became increasingly hawkish, and the market adjusted to a narrative of higher terminal rates and tighter for longer policy. Over the month, market expectations for peak US interest rates later this year moved up to 5.4%, almost 75 basis points higher than expected at the start of the month. Similar shifts in market pricing took place in Europe and the UK, and bond markets everywhere sold off, reversing all the sizable gains in January. This largely resolved the wide disconnect between the views of central banks and markets that we highlighted last month. And against this backdrop, global government bonds returned minus 3.2% in dollar terms in February. Equity markets were also impacted by the rise in risk-free rates, with the MSCI World Index down 2.4% and emerging markets down 6.5%. They are held back by a 10% fall in China following its sharp rally since October. Rising nominal and real yields, along with a stronger dollar, saw other asset classes come under pressure too, including precious metals where the gold price retreated by more than 5%. While recession risks in the US and Europe have diminished in the short term, they remain real for the rest of the year, especially given the normal lags in monetary policy. But the recent rise in bond yields is creating valuation opportunities in government bonds, which, unlike credit and equity markets, would be beneficiaries of recession. The 10-year real yield in the US had increased to over 1.5% at month end, a level which offers some valuation appeal after more than a decade of very low or even negative real yields. We are therefore taking opportunities to add to defensive assets in our portfolios through shorter duration government bonds, while biding our time before adding to risk assets. Recovery lies ahead, and we are optimistic for markets over the next 12 months, but believe it's prudent to temper that optimism in the short term, given the risks and uncertainties that we see.
February was a tough month for global markets. We saw all major asset classes declining and market sentiment deteriorating, with concerns around inflation and interest rates coming back to investors' minds. The Harmony portfolios posted losses of 1 to 5%, with the regional exposure of the funds actually having more consequences than the risk profile of them. And that was because bonds in the end offered no protection at all and even underperformed equities in some instances. A reminder of what happened for the best part of last year. The European and sterling funds were relatively stronger thanks to a resilient home market, while the two Asia funds lagged. Asian equities generally underperformed other regions. And that was mainly because of a stronger US dollar, up 3% over the month, but also due to the whole Chinese reopening theme losing a bit of steam along the way. The main drivers behind these market falls were bond yields. They increased by about 40 basis points on average across main markets and key maturities. That in turn put pressure on bond pricing as well as on equity valuations. But looking closer into the key performance drivers, the main contributor to performance was the Morant Right Fuji Yield Fund. The strategy is held at 3 to 4% target weight across all portfolios and is looking to buy undervalued Japanese stocks. They focus especially on mid-cap companies that have a solid balance sheet, they're cash rich, and they're willing to return their capital to their shareholders in the form of dividends or share buybacks. The strategy is up some 5% in Japanese yen terms in February and up some 22% since we bought them first in summer 2021. By far been one of our best performing equity funds. And to give you a comparison, broader Japanese equities are up only 10% over the same 18 months period. But also other value managers like Magallanes in Europe or Red Wheel in the UK posted similarly strong gains against their respective benchmarks. On a more negative note, precious metals were not so precious last month. We've seen gold and silver losing about 6 and 13% in February, giving up about half of the gains they had accumulated since the start of their rally in mid-October of last year. And typically these assets correlate negatively with real yields, increasing in value when yields fall and vice versa. And that's because the opportunity cost of holding non-income paying metals changes in time. Around the middle of the month, we reduced our allocation to short duration high yield bonds in the cautious and balanced portfolios, recognizing that credit spreads are a bit compressed and that the increased default risk we are observing in the asset class is maybe not being richly compensated for. So we have reinvested the proceeds into cash funds that instead offer very attractive yields of 4 to 5% in sterling and US dollar terms for what is basically a low risk investment. Our current positioning reflects some caution despite our midterm outlook being constructive. We have been in fact adding risk selectively over the past few months when valuation opportunities became apparent, and today we're positioned to benefit from recovering markets. We are conscious though that there are still risks out there, and we'd rather navigate cautiously through the next few months.